Hi everyone, today we continue to learn government expenditure part 2. For part 2, the course targets are we are going to learn the relationship between government purchase and household income flow, and then we are going to discuss how government purchase create an income effect or wealth effect on households. And then we move to understand the relationship between government purchase and private investment, as well as its relationship with employment. First, we start to consider the relationship between government purchase and household income flow. We consider the case we learned that an insightful household, how does the household look at its budget constraint? Remember, insightful household budget constraint is just like a traditional household budget constraint without government. When there's a government for an insightful household, he know that government is like a loss of income. Basically, the government would add a minus PG, which means minus government purchase from its income flow. In other words, the existence of government simply is like a hand that's going to reach your wallet and take away the amount of PG dollars that he needs to spend. That basically is the effect of government's purchase that create on your wealth. And later we are going to use this effect to analyze an impact on the entire economy. Now we continue a full analysis of the wealth effect of government purchase. So recall that we have the insightful household budget constraint, and those on the left-hand side basically is the income net of government purchase. It will be used for either consumption or for investment. Now we consider the case that suppose government increase its expenditure, which means the income net of government purchase would decrease. Suppose the increase of government purchase decrease the cash pile by one pile. Then somehow to balance the budget constraint, those four piles on the right together must decrease by one pile. So the question we are facing is that before we have the income net of government purchase to be 4 piles, and among those 4 piles, 2 piles of cash are used for consumption. Now after government purchase increase, the piles of cash available is only 3 piles. Then we are going to ask, then what would happen to consumption after this one pile of government purchase increase such that the income net of the government purchase decreased by one pile? So when government purchase increased by 1 unit, if we assume price level is constant to be 1, then this G increased by 1 unit. So the cash pile dropped by 1 unit, we know it's create an income drop for the household. And of course, the household will feel unhappy. It would create such a wealth effect that consumption must decrease. But the question is, how much would it decrease? It actually depends. If such a government purchase increase is a temporary phenomenon, then consumption, due to consumption smoothing, consumer will spread this income decrease across various periods so that it does not have to decrease consumption as much as government expenditure increase. So in this case, we saw that government purchase increased by 1 unit. However, consumption due to wealth effect would decrease, but it will not decrease as much as government expenditure increase. But the story would be different. If government purchase increases permanently, which means that such kind of one piles of cash drop happened permanently for every period. In this case, such a permanent increase would mean that each period suffered from the same 1 unit of income drop. Then permanent income actually dropped by 1 unit. So there's no way that consumption smoothing is going to smooth the drop across every period, since every period suffered the same one unit drop. Therefore, consumption would decrease exactly as much as government purchase increase. In this case, we see government purchase increase by 1 unit, and consumption decreases exactly by 1 unit. With the understanding of government purchase wealth effect, it's time to learn the relationship between government purchase and private investment. Remember that when we sum all households' budget constraint, then the wage and the rental income actually will be equal to the GDP of the entire economy. Therefore, we can replace the red block to be GDP. In addition, we know that when we sum all households' budget constraint, whenever there's household borrowing, there must be somebody lending. Therefore, the property bound holding or the change of property bound will be equal to 0, so that we can drop those two terms out of the equation and end up with the equation that we see on the bottom line. And then when we move around the equation, we actually end up with GDP is equal to PC, which is consumption, plus the capital investment part, and plus the government purchase. Furthermore, we can divide both sides by price. Then we end up with real GDP is equal to consumption plus capital investment plus G. So we have consumption, investment, and government purchase. For the time being, we only analyze the wealth effect of government purchase on consumption. We start from assuming that such kind of wealth effect on labor supply does not exist. So we assume that labor supply is fixed. In the meantime, we know that capital rental market capital supply is predetermined and is fixed. Therefore, with these assumptions, actually the production input L and K are fixed today, so that in the following analysis, we can assume that real GDP today is fixed due to fixed labor and fixed capital. Now we move government purchase to the left-hand side, so that we have real GDP minus government purchase, which actually represent all the households' income net of government purchase. And this income net of government purchase, we know that it can be used only for consumption and for investment. Here we don't have bound because we sum all households' budget constraint together. And then we learn that when government increases purchase temporarily by 1 pile of cash drop, then if it is a temporary thing, then consumption would decrease, but it will not decrease as much as government increase. Therefore, it must mean that part of the income decrease must be offset by investment decrease. Therefore, when government purchase increase is temporary, then it will be able to crowd out private investment. So private investment does drop in this case. We use the other way to express the idea. Suppose the domestic economy is Taiwan, and every period today, Taiwan produces so many baskets of commodities. This represents our real GDP level. It can be used only for government purchase or for household consumption. And suppose that before government changes purchase level, we have 3 baskets consumed by government, 2 baskets consumed by household. Then actually real GDP minus G and minus consumption further, which will be the investment part, which is actually called national saving, which is the part of the production that's not consumed by neither government nor household. Then it will be equal to the remaining 4 baskets of real GDP. Now, if government decide to take away one more basket from saving for its own purchase needs. Then, if consumption does not change at all, national saving would drop by one basket, which means that investment will be equal to saving has to drop by one basket. But with the income effect that created by government purchase increase, consumption will change, it will decrease. But by how much? We know that for a temporary government purchase increase, it will decrease, but only decrease maybe half a basket, which means that the other half basket would be able to save the drop of national saving, but still, national saving still is less than before, less than 4 baskets before. So national saving still decreased. This is when government purchase increase is temporary. Now we continue to the case when government purchase increase is permanent. When government purchase increase is permanent, when it's increased permanently by 1 pound of cash, which means it's take away 1 pound of cash from the household every period. In this case, consumption would drop exactly by 1 pound of cash. Therefore, at the end, the budget constraint still holds without any adjustment on the investment side. Therefore, there's no investment change. In this case, we end up with the phenomenon that when the government purchase increase is permanent, it will not crowd out private investment. Continue the analysis using the graph we had before. Before the change of government purchase, we already have 3 baskets consumed by government, 2 baskets consumed by household, and remaining 4 baskets are saved and used for investment. And now if government purchase decide to increase by 1 basket, without any change, national saving has to drop by 1 basket since the government take away 1 more basket to consume. And whether saving would drop so that investment has to drop depends on how consumption react. When such kind of 1 basket increase of government purchase is permanent, then consumption actually would drop by 1 basket as well, which means that households are willing to sacrifice 1 basket of consumption for every period and put it back for national saving. In this case, actually, national investment would be intact, would be 4 baskets as before. Therefore, national saving unchanged and national investment is unchanged as well. Earlier, we assumed that employment is fixed. Now we relax the assumption and we are going to discuss the wealth effect created by government purchase on employment. We know that whenever government purchase increase, it's actually like taking away the income flow from the household. Therefore, it would create a wealth effect that makes the household unhappy. Such a wealth effect will decrease its consumption, also decrease his leisure time. Therefore, his working hour will increase. He will increase his labor supply. So, on the labor market, whenever government purchase increase, it creates a wealth effect that will increase labor supply, which will make the equilibrium wage rate drops and employment level increase. And because normally higher labor input will increase the productivity of capital. Therefore, in capital market, capital demand will increase due to higher marginal productivity of capital. At the end, the equilibrium rental price of capital will be pushed up. Now we can use what we know from the impact on input market to analyze what happened when government increases government purchase due to wartime spending increase. This is a table that reflects the U.S. wartime spending, and we know that during these 4 war times, actually government purchase increases, and with the increase of government purchase, indeed we see that consumption will drop. It can be explained by the negative wealth effect that's created by government purchase increase. And also, war is not permanent. Therefore, such kind of government purchase increase is a temporary phenomenon which can create significant crowd-out effect to decrease gross investment from the private sector. And however, we saw that real GDP during wartime actually increased. And one of the reasons we can explain it is because that such kind of government purchase increase create a wealth effect that increase labor supply, so that total employment actually increased during wartime, which can feed back to the production side and increase our production. This is what our theory can provide to explain the phenomena we observe from the data.